We have seen one of the most turbulent years in recent history, and we had no idea the roller coaster that we were in for in terms of the stock market and in terms of property prices. Fast forward now to the end of 2020. The big question is, what is going to happen in 2021 to the property market in the UK? Well, to save you going through the whole video, the answer is that nobody truly knows. Everything that you'll read in the headlines, all of those YouTube videos that you're going to watch on the 2021 market is all opinion, just like mine in this video. However, what we can do is look at the stats, facts, and the data to really understand what are those horizon risks. And ultimately, we can understand what could impact the property market next year. The problem with the current market is that there is a lot of uncertainty. We've got Brexit looming at the end of the year. We have no idea what's going to happen with the next wave of the virus. One thing that I can guarantee that you will see is definitely a lot of scaremongering within the news headlines. Newspapers are built as a business to sell stories and sell headlines, so you can't trust what you see in the papers. Naturally, what we see at the end of the year as well is a kind of gradual slowdown in the market as we get closer to Christmas, and as we go through winter, people are less likely to sell their homes. So as a result of that, what you're going to see in the headlines is a lot of newspapers saying it's beginning, the doom is coming, but actually you should ignore that and see past it and look into the data. If you're new here, my name's Matt. I work for a bank by day, I invest in property on the side, and I simplify insights on property, productivity, and tech. If you haven't already, please consider subscribing to the channel for loads more videos. If you haven't already, please consider hitting the like button for 7 years good luck. Back in April 2020, when we went into the formal lockdown first time round, the property market was literally frozen in time. Savills predicted that there would be a 5 to 10% drop in the property market and property prices. To some degree, this did kind of happen, but the reality of the data in the middle of the year that there are so few transactions happening that Rightmove and multiple indexes stopped all of their monthly index market updates because the data was so unreliable. And then literally a few months later, you have lockdown ending, the government announced their stamp duty tax break, and we saw a huge property surge, which basically meant that a lot of the kind of commuter belt towns and countryside locations had a huge boost in interest and sales as a result. So you have a great incentive from the government, and then you have all of this pent-up demand that are ready to go and ready to start all of these property transactions again. And ultimately, this means that it's going to drive up property prices because of this. It's all about supply and demand. So one thing that we do know now, coming towards the end of the year, that there are two temporary factors affecting the property market. The first one is the stamp duty tax break that the government announced, up to £500,000, and the second is all of that pent-up demand that was there during the summer that is now catching up with the market. At some point, both of these have to end, and that is going to be at the start of next year. Naturally, that means that there is going to be a slowdown. In the 2008 recession, we saw something very similar where the government announced a tax break for stamp duty, and as a result, that had to end at some point, and when it ended, there was a surge just before, and then the moment it ended, there was a huge drop. But then, over about 6 months, that kind of natural demand kind of went back up to normal levels again. I'm going to explore 8 different risk factors that you should be thinking about and looking into in more detail to consider what's going to happen to the property market next year. The first is Brexit. Now, this is not really talked about much in the news because of the virus, but Brexit is coming at the end of the year. We're coming towards the end of the expiry transition period where an agreement needs to be in place. The reality of the situation though at the moment is that the UK and the EU have got lots of major issues that they still haven't really worked through. And without that strong agreement in place, it means that if we go past the transition period on December the 31st, that there could be some instability within the UK economy. The second major risk factor is the furlough scheme. Now, the furlough scheme was created in the UK to subsidise wages and jobs up to 80% of their normal pay. Now, this is great and it keeps people in their jobs, but companies are really struggling at the moment, especially with the second lockdown. At some point, the reality is the furlough scheme has to end, and all the furlough scheme is doing is keeping unemployment rates down and stopping companies and businesses from making redundancies. At the point where furlough ends, that means that unemployment rates are going to shoot up, and if people are unemployed and they have mortgages, it means they can't pay their mortgages, they start to get into arrears, and then that's when repossessions happen. Another risk factor is another peak with the virus itself. A lot of people are only thinking about 2020 at the moment and going through the second lockdown that we have at the moment. The reality of the situation is that a vaccine is still going to take some time longer into the future. So I would expect at least the first good few months of 2021 are going to be exactly the same as 2020, where we have lots of uncertainty, we have no idea if we're going to go into more lockdowns, and that's a real uncertainty in the market. At the end of the day, if we have more waves and we have more lockdowns, that means that the economy is going to be slower, and thus that's going to continually impact the property market. The other big question on this is, what are the government going to do to subsidise and incentivise people to keep the economy going and keep property prices going if more lockdowns occur? The next risk factor is that the Bank of England just this week announced that they're going to pump £150 billion into the UK economy. Now, in basic terms, this is called quantitative easing, and what quantitative easing is putting money back into the economy to keep the economy stimulated and growing. This typically only happens when there's real struggle in the market, and it stops the market crashing and it stops things going wrong, but it's something that is a bit of a temporary solution. It can only last so long, and it also decreases the value of the pound. The big question is here, is this going to be enough for the UK economy to keep it afloat and stop it tanking in 2021? The next risk factor is the end of the stamp duty holiday. Now, currently the government have announced that this is going to end in February and March next year. The reality of the situation is that back in 2008, we saw that the government did something very, very similar, and a lot of people took advantage of it and made some great savings, and it kept the property market going. And we saw a huge surge just before that deadline, and then after the deadline hits, all of a sudden it tanks off, and it took about 6 months really to get back up to the normal levels again. So this could be a good opportunity, just as the stamp duty tax break ends, to look at buying a new property, because prices should lower just a little bit. Just remember that when this does end, and we see the data in the April indexes that property prices are going down a little bit due to less demand, the headlines are going to be all over this, and there will be a ton of scaremongering. The next big risk factor is unemployment rising. Now, we've already talked about how unemployment leads to repossessions due to people not being able to afford their mortgages and falling into arrears, but there's also another reality to unemployment as well. It means that average people are then relying on their savings and whatever they have to stay afloat financially and to keep their family supported. Therefore, that demand is lower because more people are dipping into their savings that could have been used for a deposit on a house. And it means that sellers have to be more competitive on their side to lower the prices to attract more buyers. The next risk factor is all of the repayment holidays that the banks offered and all of the free overdrafts. At some point, these incentives on the products have to end, and the banks are going to start asking for money back on all of the products. This is going to be difficult because customers may get into financial difficulty, and if you have people in financial difficulty, it means that they're going to struggle to pay the mortgage. Especially when there could be more lockdowns in the future, it means that those people who are struggling now may continue to struggle in the future, and again, this adds to less demand in the property market. Banks have said that they are going to be more lenient this time round, so that's one thing to keep an eye on. And last but not least, we shouldn't forget about the 18-year property cycle. Now, throughout all of history, what we've seen so far is roughly every 18 years we've seen expansion and contraction. This basically means that we've seen a period where just after a recession, we see a recovery growth, we then see a bit of a mid-cycle dip, a bit of a wobble in the market, and then we see huge explosive growth before at the top of the market, and it crashes back down. Now, whenever this happens, it always baselines after the crash at a higher level than the previous recession, so over time, there's always natural growth. But with every economy, with every stock market, with all the property in the world, it goes up and it goes down as well. Now, understanding where we are in the property cycle today could really help shape some of your decisions over the next few years based on what has happened historically. At the moment, according to the cycle, we should be going through the kind of mid-cycle wobble or dip that we've seen traditionally. Now, there are always lots of big political events or big things happening in the world that have always affected it. We've got Brexit and the virus at the moment, so the big question is it going to break the traditional 18-year cycle? Could it just extend and be a longer mid-cycle wobble? Or has it completely thrown it out the door and it's no longer relevant? That's the big question. If the 18-year cycle is true, it means that we're only going through a mid-cycle wobble at the moment with nothing too drastic, and therefore we're just in time for explosive growth over the next 7 years. Therefore, that would mean that buying a property this year or next year wouldn't be too bad of a decision. There might be a small dip, but in the long term, over the next 5 to 7 years, we should see huge growth according to the cycle. So in conclusion, there are tons of factors to consider, and the reality is nobody really knows what's going to happen next year. But we can look at the risks and understand what's happening on the horizon to roughly grasp an idea of how could that impact the property market. The reality of investing in anything is that it should be a long-term thing. So actually, in the grand scheme of things, if you're investing in a house or you're investing in the stock market, if you have it there for 10, 20, 30 years, then you shouldn't be too concerned about any recession next year or recession in the future because you're in it for the long term And what we've seen over the course of history is that markets always go up. Quite simply, it's all about risk appetite. If you want to invest in a property now and have it for the long term, then go ahead and do it, because you don't want to lose 6 to 10 months of progress just by waiting for something that might not actually happen, and then you've lost all that progress in that time. I hope you found that useful. If you haven't already, please consider subscribing to the channel for loads more property content, and don't forget to check out one of my other videos like this one just here. Thanks for watching, and I'll see you in my next video.